Welcome to today's webinar, Retail Banking, How to Optimize Customer Deposit Lifecycle. My name is Sharon Fitzpatrick, and I'll be your host for today's webinar. Our speakers today are Tom Mayers, Director of Customer Success at SparkPost, and Hank Israel, a Director at Navantus. Tom leads Customer Success at SparkPost. For over a decade, Tom has driven pre-sales and solution teams at Message Systems, now SparkPost, and currently drives the cloud pre-sales and on-prem customer success teams globally to ensure customer success worldwide. Hank is a director at Navantus with over 27 years of banking experience across a broad range of capability areas, including commercial and retail payment operations, retail product design and management, retail targeting and offer management, and customer level pricing. In his role, he supports clients across a number of projects, including product development, scoring, customer treatment design, and customer treatment/experience analytics. During his tenure with the company, Hank has led over 50 engagements, driving value across consumer and small business operations, from product design to customer treatment efficiency for deposit and payment opportunities. Before we get started, I'd like to go over a little bit of the housekeeping for today's webinar. Join the conversation. It would be great to talk to you. We're doing a live Twitter feed, #emailpros. If you want to follow us on Twitter, it's at SparkPost and at Navantus. We have a chat box where you can send us a question or a comment. We're recording today's event, and a recording and the PDF of the presentation will be sent to you in a thank you for attending email. As I said before we started, you can also download the slides from the handouts tab and follow along. Marketing has become a dominant force for revenue growth in the battle for retail bank relationships. As the consumer preferences continue to shift rapidly to digital channels, there is both a great challenge and opportunity to create a customer journey that is more personalized and engaging. In today's webinar, we're going to be introducing you to SparkPost and Navantus, explore the evolution to customer level treatments within retail banking, the challenges of current processes, and how advanced segmentation can be applied to optimize the impact of your marketing efforts in customer acquisition. You'll hear customer case studies illustrating best practices one customer used to enhance engagement, the importance of personalization and analytics to highlight data and offer health score, how to benchmark your campaign and marketing spend across others in the industry. Both SparkPost and Navantus are leaders in their fields with a deep history of success. SparkPost is the world's #1 email delivery provider. Their customers send more than 5 trillion messages a year, over 37% of the world's business email. SparkPost empowers companies with actionable real-time data to send relevant email to their customers, which increases engagement and both top and bottom line revenue. Navantus is the leader in customer science and revenue management programs for financial industries, supporting over 80% of the largest global banks and other financial institutions. A FinTech 100 company, the firm's advisory and solution services specialize in investigating and interpreting customer needs, attitudes, and behaviors to help institutions refine pricing, distribution, marketing, customer strategies, and sales and service activities. Navantus's Price Tech is the leading deposit management platform in the US and globally, tracking more than $3 trillion in deposits. We have a full agenda for today, so it gives me great pleasure to get this started and introduce our speakers for today, Tom Mayers and Hank Israel.
We thought we'd start today's session talking about what has changed in dealing with deposits and customers in the financial services sector. In the old world, financial services, specifically deposit banking and retail banking, were focused based on physical assets that banks brought to the market. Starting with branch visibility, the #1 predictor up until about 5 years ago for which bank a consumer went to was what bank was where they could see it. Additionally, It was reliant on local sales talent from each of these stores, targeting customers in the neighborhood to bring those assets inside. And as a result of that, what really drove success for organizations was the scale of their branches. So the size of my deposits was fairly equal to the branch share that I held in any given market. What we've observed over the course of the last 5 years is a dramatic shift in this paradigm. For the first time, branch share represents less than 50% of the decision that a consumer makes in attracting customers. And as a result, what we find out is that there's new factors that are emerging. Customers are moving less, and as a result, a focus on deepening core relationships has become more important. Marketing and brand have replaced branch as the number one reason for contribution. Additionally, the role of distinctiveness, analytic scale, and what we call perceived convenience are more relevant in the consumer decision. Perceived convenience being how easy is it to deal with this organization online in terms of purchasing and servicing products. And lastly, to support all that, obviously organizations are seeking to attract talent to support it. Tom, what are you seeing in the financial services industry?
Those are really good points, Hank. We've seen very similar things. In the last 5 to 10 years, the entire world has changed. Today's consumers have way more opportunities to go in different directions, and it's so much easier to migrate towards a different experience. In a recent study one of our partners has done, it shows that almost 80% of financial service customers say they feel that their bank is more transactional than consultative, and they don't like that. They want to have a personal feel, a personal interaction. 40% of those would stay with their bank if they provided a more personal experience. That's pretty important information. Customers want a conversation. They want a consultation with people. I think that's pretty important to cover.
That makes a ton of sense, and it really sets up what we thought was the primary challenge that we might focus our discussion today on, which is looking at how financial institutions, retail financial institutions, gather deposits. What's really interesting about retail banking is that most banks have to recapture 20 to 25% of their deposits annually in the form of promotions, and in the form of relationship development, and so on. To date, most organizations have relied on broad-based marketing in order to attract that. And while it is very effective in driving the volume of deposits these organizations need, it's extraordinarily expensive. As an example, an offer thrown in the market for a deposit rate of 2.25% can cost as much as twice that when you take into consideration the repriced existing balances that a bank may have, as well as those customers that we call promo hoppers that move from product to product, or from loan opportunity or deposit opportunity to deposit opportunity. Additionally, to reacquire these deposits is extraordinarily expensive initially. It can cost as much as $3 to $5 per $100 acquired for ineffective offers, especially as we move into the digital realm and the opportunity for email solicitation, where those offers aren't targeted accurately to the customers that will respond. The most interesting thing that we find is, out of the mass market offers that are out in the market, almost 85% of the response is coming from existing customers. And banks just have not figured out how to engage customers in that dialogue to capture those deposits without having to go to the mass market and reprice their balances. What we've observed is that banks can effectively engage their customers in deposit augmentation directly. They can reduce their margins by reducing the amount of promotional rate required. They can reduce their marketing costs per $100 acquired through efficiently marketing to those customers that have additional deposits. And they can become more relevant with their brand to the customers that they're serving. That seems very consistent with the findings that you had in your study, Tom.
Yeah, absolutely.
What we've observed is we've gone through and worked with different organizations over the last 10 years, is that there's really 6 levers to effective campaign improvement that affect both the revenue and the cost side of the equation of running deposit campaigns. First of all is targeting the right customers and understanding the cost of each of these customer sets for who we're going after. The second piece is offer structure. When we talk about that, it's the conditions that we might place on an offer, the message itself, and the channels in which we might deliver that offer. And then finally, pricing, which has become very important in terms of understanding the reference rate. We use the term WAMP as the reference rate, weighted average market price, and how I price against that weighted average market price to attract customers. In addition to that, in delivering these messages, there's an opportunity to optimize messaging, delivery channel, and customer planning. Tom, do you have thoughts about how that might play out?
Yeah, I really do. There's what we've seen in many of our financial services customers is that you understand who to target, and you may understand what price model you need to go after, but understanding what channel and what message to deliver when you're planning out that customer journey is just as critical as the initial marketing piece. So making sure you have the right format of message sent over the right delivery channel to the right customer at the right time. That's really a big part of the puzzle. So it sounds like a good opportunity to ask our viewers to feed some of us with their opinions.
So the question to the audience is, which of these levers is the most challenging for you or your organization?
We have opened that poll, and you have choices of targeting, offer structure, pricing, delivery channel, or customer planning. While we're waiting for it, let me ask you guys, why are these the most challenging?
That's a great question.
I could speak to...
Yeah, go ahead, Hank. I'd love to hear that.
Talking to customer planning, I think it's very complicated because most organizations that we work with have many different products that they wanted to talk to select customers with. And trying to schedule and block those communications so that they don't talk over each other, if you will, it has become a very complicated process when you think about from deposits to loans to payments to credit cards, all of the different things that an organization might offer.
Yeah, you bring up some interesting points. There's one thing that didn't quite make it onto this list is the concept of fatigue. Targeting is really important, but what channel do you use and how often do you send that message? You talked about messages talking over each other. You can bombard the customer with too much messaging as well. So understanding the frequency of that targeting, what channels to send those on, as well as the structure on the pricing is pretty critical. That all feeds into the customer planning.
Well, here's what the poll comes up with. It's 25% for targeting, 0 for offer structure, 50% for pricing, and 13% for delivery channel and customer planning. So I'm going to close the poll and send this back to you guys.
It's actually quite interesting results. I'm surprised at the pricing because quite often what we found has been that the cost of not acting is much worse than the cost of actually enabling tools. Interesting. Well, see how that goes. Thanks.
Absolutely. Well, I can speak to 2 of those. Hopefully, Tom, you can speak to some of these as well as we go through the conversation. As we've worked with different clients, we've really honed in on this targeting challenge. What we find is not all customers are created equal. There's really 3 dimensions that we evaluate customer offers on. One is around demand. And what we find is that based on age, wealth, and perceptions about money, different customers have different interests in deposit management. And as a result, how we talk to those customers and the types of offers that we present to those customers to become irrelevant are really important. The second piece of this is really around the behavior of those segments. And we break down customers into 3 dimensions of the value and cost that they might bring to the organization. The first one is, how often do they move material deposits to the bank? If a customer very rarely or doesn't perceive the bank in that light, making an offer to them may not work. So the first piece of this is their shopping behavior. How often do they bring us money? The second piece of this is, how elastic are they? I might make an offer to a customer with a very large rate, but they may have brought me the money for no rate at all if I just had the conversation around convenience and the ability to serve. The final question that we ask to customers is really around, how long are you going to keep that money with us, and trying to understand that. And we're able to break apart customer portfolios to answer these questions. So some customer segments are going to be much more valuable to you, those that require less rate, bring a lot of money, and keep the money with you for a long time, are obviously going to be more valuable than customers that require a lot of rate and keep the money with you for a short period of time. What you'll see on the far right-hand side is that we can use these measures to identify the marginal cost of funds or the cost of acquiring that deposit. And what's really exciting about this is that we can rank order portfolios for augmentation around how much does it cost to maintain those deposits after 1 year. One of the challenges that we've observed in the market is that early campaigns have focused in on day one production of deposits with the campaign. Did the customer respond to the offer? What we think is even more important is how valuable were those deposits over the course of 12 months. And so as a result, we built a measure to be able to understand that if a customer responds, how much money is left at the end of the 12 months and how much did it cost to maintain it, so that you have an accurate assessment of the profitability of that deposit acquisition. We think this is foundational in terms of how you might think about putting together effective and efficient campaigns in driving deposits, both in rising rate environments as well as falling rate environments. As we turned, and this seemed like it was less of an issue for most of the respondents who are listening to the presentation, we find that actually the design of these offers have a tremendous impact in terms of their profitability. Obviously, the benefit being a high rate is very important. We consider, though, the conditions are also very important. Engaging customers to retain their deposits may actually reduce the day one production of those deposits, but if we play that out over that 12-month period that we're talking about and driving the longer term value of that deposit, some of these conditions can actually increase the value over time. So while I'm not moving as much volume or production in terms of numbers of customers or day one deposits, I may actually retain more of those deposits at the end of month 12. So one example of a condition like this might be an active checking account in order to get the promotional offer. Message and fulfillment experience are also extraordinarily important. What we found is that as banks are experimenting with digital channels as well as the branch, bringing consistency to the experience of how that offer plays out is extraordinarily important. We've also observed things as simple as changing the color of DM and EM messages going to customers can change response rates by as much as 20%. So making these a part of what we're testing as we look forward in terms of optimizing response can be extraordinarily valuable. Tom, have you seen some of these in your experience?
Yeah, definitely. We've seen similar things with our customers as well. Yes.
Super.
Yeah, the fulfillment and experience is kind of a really key point, particularly for us in the messaging world. One of our mantras for a very long time has been, right message, right time to the right person. It's key, really, to be able to create that whole journey for the customer from beginning to end. Delivering that message on time to the right person is absolutely critical.
Yeah, I think we found the same thing, and even more interestingly, as we look at that fulfillment challenge, is that we're also finding that because of multi-channel offers that are going out, is that organizations have to be ready to fulfill in the channel that they make the offer in. So if I send out a DM message or an EM message, I need to be able to fulfill digitally because that's what customers are expecting at this point. So sending out a DM message and telling the customer to go to the store to get the promotion or the offer has been less than successful with many of our clients.
He's an immediate message to your phone so we can be right time and right place, but we're going to make you drive 20 miles to actually take it up. Doesn't help.
Exactly. No, exactly. The waterfall kind of falls apart there. Turning to price elasticity, this is something that we've worked with in the consumer context for the last 20 years, experimenting across the world with how we present rates to customers and how they react to different situations. What we find is pricing is extraordinarily important, and whether we like it or not, consumers are naturally price analysts in terms of they concoct in their heads the concept of a reference rate, which is, hey, I've seen a rate out there, and I heard that Chase or a bank is offering 2.5%, so that when I look at offers from the bank that I bank with and it comes out at 150 basis points or 1.5%, all of a sudden that does not look as attractive. And so what you'll see is on the left-hand side of this elasticity curve, we're in the uncompetitive zone, or falling off the cliff is what we call it. You're priced so low as the customer to say that reference rate just doesn't make any sense. Similarly, they might see an offer for 2.75% from their bank when the prevailing rate is 2% in the market, and all of a sudden that will look really attractive. And that's where we're on the right-hand side of this curve, and we're able to attract balances really effectively. The most interesting thing that we've observed in the market is it used to be the commonplace wisdom when we first started out in this is to always be in the middle of the pack in terms of pricing, is never price more than your competitors and never price less than your least expensive competitors, and you'll do just fine. And what we found is that is actually the most expensive part of this curve to be in, because anywhere between the two X's on this chart, if I increase rate to the right, I'm actually paying more than it would require to keep those deposits on books. So for every percentage I move from the left X to the right X, I'm basically throwing money away. So it's really important, depending on where you want to be, is either we want to be at the profit maximizing point, or where we're maintaining deposits but maximizing our margin, or we want to be far to the right to acquire new deposits. What's interesting is that this is breaking apart. It used to be those reference rates were based on the billboards in branches. What we're finding is those reference rates are now becoming customer-centric as more and more banks are becoming more and more targeted in terms of how they make these offers to consumers. The consumer reference rate might change a lot. I'll give you an example. Is in the branch, most banks are offering 0.5% on their deposit offers. However, for a select few customers that banks choose to make offers to, they may be seeing rates as high as 2.5%. So as a result, that is their reference rate inside that segment, and understanding how that changes depending on the customer segment that you're working with is extraordinarily important in order to make your offer material and relevant to that customer base, and also align it to what the objectives of your institution are. So putting all these pieces together, what we find is that we are able to identify the right target, and then based on the work inside the bank to understand what you're trying to do, grow deposits or maximize your margin, we're able to assign what the appropriate offer would be for any given customer segment. The next step here is to kind of translate that into how you would deliver those messages to customers. And for that, Tom, I can think of nobody better to talk about this than you.
Thanks, Hank. The immortal Tina Turner once asked, "What's love got to do with it?" I think this kind of says it all when it comes to communicating with people. It's all about relationships. If you understand what your customer is dealing with from a fatigue or from a positional point of view, understanding what that looks like gives you a much better grasp on how to communicate effectively with that user. Something that we may have mentioned at some point, I believe Sharon said at the beginning, that SparkPost processes nearly 40% of the entire world's commercial email. Because of that, we have a huge data footprint about behaviors, how people work with their email and look at their inbox. And so what we've done is we've taken all of that data in a sanitized way so that we can look at behaviors and patterns. And what we do is we can take the messages that you're sending out, those offers that you're pushing out through email, we can take a look at that and compare that to how you're actually being able to deliver that to somebody's inbox, and what the relationship looks like. What's their propensity to engage? Will somebody actually click on that message and open it and read it and do something with it? Because if they don't, all that work you did putting in the offer and calculating all of that and sending it out in an email is completely wasted. Understanding that they can actually click on that and know what they're doing is absolutely key, but you don't know that until you understand the relationship. And that's what this particular chart does. Some of the other things, you'll see some of the other things we do, not just counting the score, in fact, some of the things that go into making that score are actual engagement stats. How often are people open and clicking? How frequently do they do that? And how relevant is that? Along with that, along that same time frame, with those same buckets of customers, what's the engagement rate look like, and what's the unsubscribe rate look like? You can get a really good picture of your audience by diving into that data and understanding what that relationship is that you really do have with your customer. That whole concept that used to exist pushing mail out in very large blasts and then waiting for a couple of days and then looking at scores is completely irrelevant today. 5 years ago, as we had said, the world has changed. 5 years ago, that made a lot of sense. That was really the only way to do that. Today, you need an immediate, real-time way to gauge whether or not you're having a good relationship with your customer. Sure. I think we've actually got a couple of case studies that we can look at to explore this a little bit as well.
In this section, we're going to look at customer case studies, the problems and challenges they faced, and how they solved them by using personalization, segmentation, and smart email strategies.
Tom, I think the tools that you just described is actually really powerful. So when I think about how the clients that we work with think about targeting clients, we don't know always what rate is the most relevant in a particular time frame, because in volatile markets, the rates change pretty regularly. And so being able to have 4 or 5 different cohorts of customers that we send different rates to or different messages to, and seeing pretty quickly on which one's going to be the champion so that we can readjust our strategy is actually an amazingly powerful tool in terms of where we're headed. And it really ties into what I'm going to talk about on this page, which is this is working with a client, the U.S. network bank. It's relatively large. What you see on the right-hand side is how our scores came together to rank order the portfolio in terms of cost. So working from the least costly decile, that would be an offer rate of 1.5%, what we find is that was the least cost decile to offer a deposit marketing campaign to. And the most costly decile is obviously decile 10, where it's almost 5 times as expensive to collect deposits. What's interesting when you look on the right-hand side is that for this particular institution, that's where they gather 40% of their deposits. So they are gathering some of the most expensive deposits that are available. But however, by identifying these different cohorts of customers and being able to target offers into those that we think will be less expensive over time, I can actually change the mix of customers that we're driving deposit growth from. And this represents as much as a 15 basis point savings on the retained balances over time that a bank might experience. So Tom, I guess the way this might work is that if I presented to the engine, the marketing engine, different scores for different customers, you could actually potentially monitor which customers were being more successful with particular deposit campaigns. Is that right?
Yeah, absolutely. In fact, we have a whole alerting system and an automation system built into the tool that allows you to see that in real time. So if you dip below a certain factor and you're losing ground with the relationship with your customer, which is really like a share of voice, right? You're saying how relevant am I to that particular user? If that drops down below a certain level, you can send an immediate alert to the account manager or the marketing person or whoever's managing that to make an adjustment and do things on the fly. It's pretty important to do that in real time.
Very cool. Very cool. If we move to the next slide, we can talk about another example. This is a little bit more interesting, is that what we found is that customers are seeking that consultative approach to marketing. And in the past, when I did the past and last version of marketing, is I would send a bunch of messages out based on my product demand. If I wanted to grow deposits, I would send out a bunch of messages or mass market a deposit offer. If I wanted to raise loan dollars, I would send out those product messages. But what it didn't recognize is that the customer's on a journey of their own. And so what we started to do is understand that at the end of a deposit promotion, what do you do with that customer? Are you silent? Or for particular customers that might have a higher risk of attrition or of those balances going to another organization, do you present another offer to engage that customer in a daisy chain sort of way? So starting to create an engagement journey where we acquire a balance in the first campaign and we try to retain a balance in another campaign and potentially deepen a relationship even further in a third campaign. So we're starting to identify which customers do we need to talk to at the end of campaigns. The neat thing about this is that it represents a huge savings in balances. Traditionally, when banks needed to retain balances, they would up price the whole portfolio rather than talking to those customers that only see the value of price in the relationship and try to redefine the relationship that they have with their customers. Tom, do you have campaigns like this where we've looked at engagement over time?
Yeah, definitely. And we highly encourage our customers to keep track of that from a conversational point of view. Sending out a ton of messages over and over again where you're just really having a one-way conversation is just screaming at a wall. You're really not being effective. What we found is that less is quite often better than sending, more volume. And think about it yourself. Would you rather have one quality conversation with a consultant or 10 boring meetings? I mean, that's kind of a no-brainer for most people. What we found is that you can actually get much more productivity by sending fewer but more consultative, direct, and personalized messages than you can with a whole bunch. We actually had one customer who we actually reduced their sending by 70% while increasing their open rates by 4 times. That open rate translated into revenue, and in that case turned out into a much higher profitability because they were actually sending 70% less mail. So it seems counterintuitive to say, hey, if I send less messaging, more people are going to interact, but it actually works. And you get a much higher rate and you get a much more loyal customer. Those people turn into evangelists for your product. They're not just customers anymore because you're treating them with a little more respect for their inbox, and you're having a consultative conversation, not just a one-way blast. I think there's some.
Yeah, no, it's really interesting. We've seen the same thing, is that the response rate when we're very targeted with those offers actually drives up, and we think that it's really that the customers is feeling that the messages are more important because they're not seeing as many of them, as to where if they see one every day, they know that everything is kind of business as usual. So the less you talk, the more they hear. It's kind of interesting.
Yeah, exactly. I think on the next slide I might have a sample on this as well. But if I get at 10 o'clock every Monday, I get a marketing mail that is the same as the last marketing mail I got with 3 or 4 different words different, I'm going to get bored. But if every once in a while, on a completely random basis, my account manager sends me a personalized message and says, hey, Tom, we noticed this thing that you might be able to get some use out of, and it actually is relevant, I'm going to pay attention. And I do. Those are the people I keep on paying attention to. So understanding what data feeds, what data feeds you have, feeds a much better user experience. That customer feedback is absolutely critical. And that's why we build in things like the reporting tool that we talked to earlier. It can tag things that you didn't realize were an issue before. We have tools to help you understand better signups and encourage better engagement with that data, and make sure that you're actually talking to real people and not fake addresses, for instance. We can do things like make sure that your mail is actually flowing and predict behavioral problems with your mail or the way things will be delivering in the future. So all of that kind of feeds out of the data flow, making sure that you understand who you're talking to and how you're delivering that message. There's a really good example of this. One of our customers, a customer that I cannot name, but we have a very large consumer bank that has branches in both the U.S. and the U.K. And we're a global company with separate data products on both sides of the Atlantic. But this particular customer they walked away from the batch and blast mentality years ago, and they heavily utilize our technology to do one-on-one transactional mail. They do it millions of these a day, but they do every single one as an individual communication, and they treat every single conversation as a conversation with a customer. They don't batch anything. They don't have any kind of form marketing whatsoever. And every communication is specifically personalized and routed for that particular customer. They leverage real-time feedback so that when they send a message out, they can gauge how that user is reacting to that message in real time, so they know how to send the next message, which is really critical. Understanding how to move forward with that communication, it's a long-term conversation. You're not just screaming at a wall. You're having a conversation. They've saved tons and tons of dollars by leading with email and then falling back to paper afterwards. That's actually a really key thing. a number of customers that I've worked with personally in the regulated industry sector, both in financial services, government, insurance. Most of that was a paper world for a really long time. And a lot of that is still actually delivered in paper. Well, paper is really expensive. But if you can find a way to translate that into an email first delivery, that's a whole lot cheaper. And what you can do with real-time feedback is that you can send that as an email first and watch for feedback. If that message fails, then you can do some automated processing to go to another channel, an alternate email address, or turn that into a paper delivery if you need to. You can't do that without the real-time data. The results on that are absolutely stunning. If you look at the graphs on long-term dollar savings and compared to the visibility with a customer, it's a no-brainer.
What's even wilder is that if you take that savings and you reinvest it in the customer in the form of more powerful benefits for the customer, either higher rate or a higher cash offer that you would have spent on email or mail that didn't go where it needed to go, the offer becomes that much more compelling and your close rate goes that much higher. So thinking about how you can take some of these savings and redeploy them to become even more effective, it becomes kind of a virtuous cycle of benefits.
You took the words right out of my mouth, Hank. We use the term virtuous cycle here all the time. If we can do the right thing at the right time and have you send less waste and get to that customer directly with a relevant message, you're going to spend less, you're going to invest less on the waste, and you'll have more to put back into a quality product that then makes the customer love you more and want to receive your messaging. It's absolutely a virtuous circle. Yeah, so I guess that brings us to our summary. Wow, it seems so short. The net of this, if you take anything away from this conversation at all, the basics are that old school, that 5-year-old concept of batch and blast. I'm going to tee up 3 million messages and push them all out and check for the results in 3 days. That is bad. Don't do that anymore. This whole new world that's developed over the last 5 to 10 years, Amazon can deliver anything to you door anywhere in the world at the push of a button on your phone. You can text money to anyone in the universe over the phone in a couple of seconds. The world is different than it was 3 to 4 years ago, and you need to treat communications and your messaging with customers differently as well. The new world is all about conversations and real-time analytics.
I think that makes a ton of sense. I mean, it's really interesting. It used to be that it was the branch scale divide that really defined the winners from the losers inside the banking industry. And what we're seeing, it's really the analytics divide now, is being able to know more about your customers and being much more prescriptive in the communications that you have with them is defining winners from losers now. And so the question is, how do you scale those things, leveraging tools in the market to be able to deliver on this new capability that's required to compete in this very challenging environment?
Yeah, absolutely. I couldn't agree more.
Well, we're getting up to our question time, so we've got quite a few questions from the audience. Just want to also give the audience a challenge I put in chat. Many of you answered pricing, which surprised our panelists. So tell us why pricing is such a challenge for you, just to kind of share the information if you have a chance. Let me go to the first question. Tom, you seem to collect a lot of data. How are you protecting my privacy and all that?
Yeah, that is a fantastic question. So SparkPost has been around a very long time, and we are a global company. We were one of the first companies that were GDPR compliant for Europe. We actually have completely separate deployments in the US and in Europe there, so that there's full data sovereignty, and we're certified for protecting that data on either side of the pond. And we're happy to go through a certification with you as well. But as far as the actual data that gets transmitted, the only data that we store in our system for this kind of, the tools that we were talking about is fully pseudonymized data. It's encrypted, and you couldn't tell. If somebody were to use our data, they would get nothing but garbage. It only means something to us.
When you make retargeting decisions, how relevant is that data? Really?
Yeah, well, that sounds like me too. So SparkPost data is all actionable in real time. We had said earlier, both Hank and I had talked about the old world where you batch and blast mail out, messaging out, and then you wait and look at the results. Well, if you wait a day or so and then send the next message out, you've lost that customer. You've lost their attention. You're not having a conversation anymore. So all of SparkPost data is actionable in real time. We not only we collect the data in real time, but we feed it back out to you in real time, so you know, and we put it in a way that you can actually trigger external processes. So in a technical view, we actually send a webhook of real-time data to processes where you can automate the next message. You don't have to do anything directly yourself, or you can. We make it very highly available for you to do in real time, in seconds, not in days.
So I have another question from the audience. It has to go back with the GDPR. Are we going to see that in the United States? And if so, how do we prepare for it?
Yeah, I think we already are. You know, the new rules in California are a really good indication that we're leaning that way. Privacy is important, and I think everywhere around the world. We saw this in Canada, we've seen it in India, we've seen it in Australia, we've seen it in Brazil recently. GDPR was just the tip of the iceberg, and I think really you will see that. My gut says you were going to see that in the U.S. Sooner than later, and companies that aren't on board with recognizing that people own their own data and have the right to be forgotten, and that needs to be respected, are going to be left out in the cold, or they're going to be very surprised when that legislation comes in. I wouldn't be dragging my heels on that. SparkPost saw that coming a long time ago, and we built that into our entire infrastructure.
Great. This might be for both of you. Are banks really using the cloud for email? I've heard otherwise. Hank, do you want to answer that?
That is a interesting question. I'm going to have to defer to Tom on this one. How the email goes, I don't know. But we're certainly using big data in terms of developing customer level analytics. So if that was where the question was going, absolutely.
Yeah, definitely we are seeing that. In fact, when I'm not doing webinars, I'm working with regulated industry. Most of my personal customers are banks, investment firms, insurance, government. You know, you'd be amazed at the people that are not really using email. We see that quite a lot, and some of the largest financial institutions in the world are using email. They're using our services for specifically that. If you got if you received an email from your bank in the last couple of weeks, it probably came through our service somewhere.
So we have a question from the audience. Can you touch upon how the rise of digital banking has impacted traditional bank branch networks? How do you determine the right number of bank branches?
That is a great question, and one I can answer now. We've decomposed market and customer response into different factors, one of which is looking at the density of your branch network and its contribution. Again, as we mentioned, it's roughly just under 50% now, as well as your marketing presence in a market. And we can actually trade off different variables in that model to be able to tell you what the value of a branch is in acquisition and the cost of that acquisition versus spending more on marketing versus putting in more ATMs and the like.
So we have a question that goes back to the case study. You talked a lot about deliverability and that the fact that this one bank was able to send personalized emails. Could you explain or elaborate a little bit more on that, on how they're able to manage that without doing the batch and blast?
Yeah, absolutely. So inside SparkPost, we have we treat every message transactionally anyway. Even if you were to say, hey, you send 100,000 messages, we treat each one individually, and you have the ability to use a fairly comprehensive templating language. It's not substitutions directly; it's actually logical, and so you can change the message to be customized for individuals based on a lot of rules. There's conditional statements, there's array statements, you can iterate through blocks of data. So without getting really technical, you can basically send in a template that allows you to script the message to deliver and change in real time based on the data you send about the user. So it's not data we have in our system, that's data that you would provide with the message to say, this is going to Sharon and she lives in Atlanta, and here's all the data that you need. Build this message, send it, and then throw away the data. And that's absolutely how they do it. And they will feed that off real-time information. So they'll be able to say, hey, thanks for your deposit that you just did 4 minutes ago. Come back again to visit our branch. That's absolutely at 1 million messages an hour. Yeah, that's
wow, that's impressive. We do have one person that answered my challenge of why they picked pricing, and they said it's, again, a lot of people are rate hopping, and so pricing becomes an issue because it's part of the purchase or the buy decision from their customers. So just wanted to kind of follow up with that. And I know we're really reaching the end of the time we have allocated for the webinar, so I'm going to turn it to both of you for any last comments before we close it out. Hank, any thoughts? Tom, would you like to say any final thoughts?
Sure, we can.
I think we actually made Hank speechless. I didn't think that was possible.
There you go. Yeah, no, I think it's important to just realize that things have changed. The world has changed, and it is rapidly changing. Don't get complacent in thinking that we're at the same place we were 5 years ago, or even 1 year ago. What you knew a year ago about your customer is no longer relevant. You need to understand what they're doing today and react in real time in order to have a relevant conversation. It really is all about having a relationship with your customer.
It really is. What does love have to do with it?
Absolutely. Hank, any thoughts?
Thanks. I apologize. I was on mute. No, this has been a great opportunity to think about how does the physical infrastructure of getting the right message to the right customer tie with how we choose the customers. And I think that's what's really exciting about this new world order. In the old world, we put out very large messages and customers would choose us based on what we threw out there. And I think that what's really exciting about this is that we can craft our message and craft what we offer to those targeted groups of customers that we want to do business with, because they're valuable to our organizations rather than just caught up in the noise of rate hopping or other price sets of issues.
Great. We're running close to the end, so let me close it up by just inviting you to a couple of upcoming events. We have SparkPost is going to be at Opt-in, the Email Intelligence Conference in October in Carmel Valley. And Devontis is having another webinar, this one on July 16th at 2 p.m. You can visit their website and register for Maximizing Deposit Margin and Growth as Rate Declines. So we want to thank everybody for attending today. We really appreciate it, and we'll follow up with an email to the recording and to any of the materials, and have a great rest of your day. This concludes our webinar for today.